Well, happy holidays, everyone. My name is Frank Fantozzi, president of Return on Life Wealth Partners, joined by my team members, Chelsea Hussey, and I was just going to say Frank Fantozzi again because on my screen, Cynthia Yang, who leads our investment team, has my name under her moniker. So we're going to get started here in about a minute. I just want to give everyone's a heads up, so if they want to focus in on what we're going to talk about. It's always interesting to throw in a year-end market and economic perspective right after Thanksgiving, right before Christmas and Hanukkah and Kwanzaa. But we figured it's been an interesting year, a very different year than 2022. And what makes it, again, interesting as well is next year is going to be an election year. And we're going to talk about some of the things that we think are important to consider. Our role as financial advisors is always to separate the emotions from the facts and kind of lean into the facts. And while history isn't an exact predictor of the future, Mark Twain always used to say, always kind of sounds and looks familiar. And I think some of the things that we'll talk about today will bring that to light. A couple things I always like to start out with. First of all, Warren Buffett has always a famous quote, a simple rule that he says dictates his buying strategy. He says, be fearful when others are greedy and be greedy when others are fearful. We are all instilled in our DNA with this primal DNA of fear, flight or fight. And if you look at what happens in the marketplace, and really not the marketplace itself, it's actually the news. And being around a little longer than my two cohorts here, you've seen the transition from when I was growing up. I was actually the remote control in my family. There was basically 5 channels that we got to watch, channel 3, 5, and 8, and then your UH channels, channel 43 and 61, and that was really it. And you fast forward that 50 years. And then don't start doing the math, but now you have this endless streaming of news, and information is great, but what happens is when you have information overload, you start to worry about what's fact, what's not fact. Now we throw in artificial intelligence and how things can be manipulated on the internet, which creates other fears. And another way to look at fear is false expectations appearing real. And the reason why I bring that up is the reason why you see the level of news that tends to be negative is it taps into that primal DNA, flight or fight. And that's the emotion, I think, the angst that we see almost on a daily basis when we look at the news. So hopefully after our presentation today, we'll get to understand a little bit more about what has happened in the past, kind of where we're at today, and what we think is going to lead into the future. So the key topics that we're going to focus in on today is one, the election and geopolitical shocks and what that could potentially mean. And we figured we start out with something more fun because the election year is around the corner. We're going to talk about the labor market. We're going to talk about inflation and where the Fed, if they're going to stop their tightening and start loosening up, what's happening with interest rates, and potentially the portfolio implications and positioning. And a lot of our commentary is also geared around investors that are what we call long in the market. They're taking positions what could be happening more longer term versus just reactive type of positioning. So with that, I'm going to take you to the 2024 election. So Cynthia, if you can scroll to that screen.
Okay.
There we go. So I did not take this from post office and all the mugshots of all the people that are wanted. This is actually as of probably a week ago. Try to keep up with all the players. These are the 15 people who dare to throw their hats in the ring and vie for the their party nomination into the 2024 election. this is almost kind of like deja vu. Now, some people might look at it as deja vu not good, because right now we have President Biden, who's by far ahead of his challengers, and the same for former President Trump. Obviously, we don't know where his legal troubles are going to take him, but I don't know. I think even bad publicity is giving him good publicity, because he seems to be leading the Republican side, and then we have the independent candidates. So why is all this fascination, about the election? Well, besides the fact that it's 24/7 news on the candidates, and I have to take my hat off to anyone who wants to become president. I know when we were little in grade school, they always used to ask, "Don't you want to become president someday?" I look at it now, it's like, God, why would I want to do that? I know you're the most powerful person in the world, because leading the United States, but it's become a position of obviously immense scrutiny. I don't know if you would want to subject yourself and your family to what these candidates have to go through. So I do tip my hat off to them, because you have to have pretty thick skin to run in that race. But I think the reason, or the fascination of the election year, and why the leading up to the election year things can be a little more uncertain and volatile, is there's this fascination that people think that whoever is leading the nation really is going to have complete control and drive what happens in the financial markets. So usually the year before the election, there is a little more uncertainty and volatility. Why? Because each candidate runs on their own platform, and everyone's trying to get a guess what are going to be the policy changes, what social changes are going to happen, what economic changes are going to happen. I mean, if you have a candidate, for example, that is favoring renewable energy, people might start hedging themselves. Well, wait a minute, if I think this candidate's going to win, I want to buy into stocks that are supporting renewable energy. So these are things that people start to anticipate, but they forget. The beauty and the agony of the way our government is set up is there is a system of checks and balances. You have your House, you have your Senate, you have the presidency, and the way I would describe it, because I just came back from Europe on a family vacation. A government where the top dog can make changes instantaneously creates a lot more volatility for their country. You think about what has to happen in the United States to pass legislation. It goes through this total grind through the House, the subcommittees in the House, and then the Senate, then it's got to get approved by the president. It's a way of protecting the country and its people from having swaying politics that every time someone's elected, we go from one extreme to another. And I think while the press tends to publicize the far right and the far left the most, what we have found over history is that when you have balance and cooperation between the parties, you tend to have your best legislation and your best economic times. But again, that fascination of who's going to lead the country and what changes are going to happen does set a policy course, and people tend to be focused in on it. The real question is, does it really have a long-term impact on whether there is a Republican in the House or a Democrat in the House? I mean, the presidency, I shouldn't say the House, because remember, we do have the House of Representatives and we do have the Senate, and that has a lot of influence, obviously, on what happens, because that's where legislation starts in the House. At the end of the day, our feeling is that what the markets look at, and it always goes back to this. So what I try to remind our clients and people that we talk to is that we are in a capitalistic, country, and economic fundamentals, corporate earnings, interest rates, those are things that really are going to drive the performance. That's what you're paying for. When you buy into the stock market, you're buying the performance of that stock, all right, and that company. And so what I remind people to look at is and there's a lot of ways to look at your candidates and how you want to pick them. Personally, I tend to look at what is going to be the economic impact to the country, because that tends to drive the economy. But what you'll see in some of the slides that we put together, it tends to be a little more irregardless if it's a Republican in House or a Democrat in House. So again, the excitement is getting caught up in the election and how that all plays out. So if we can go to the next slide, please. So the next slide we have here is the S&P 500 index performance over a 4-year election cycle. And what you'll see is blue is Democrat, red is Republican. And what you're going to find out is on and around election day, there's often, again, this anxiety about how the president's 4-year term might impact the stock market. And what you'll see is the S&P index performance in this chart is a year of each election cycle. And over the past 92 years, the S&P index has been positive 73% of the time. It has averaged a yearly total return of 11.54%. 67 of the 92 years. Again, it's been positive 73% of the time. So it seems to be, from a prediction standpoint, it doesn't really matter which party is in house at the presidency, as the market tends to perform, relatively well over the 4-year election cycle. And I think part of that comes down to that we talked about earlier. Prior to the election, the markets like certainty, and we tend not to know when whoever's running, who's going to win, what policies are going to be predicted. And so after the election, sometimes you get what I call a market rally, because now there's certainty. Whether it's a Democrat in the presidency or a Republican in the presidency, the market tends to know, all right, this is the platform the candidate ran on. This is what the candidate's going to try to implement. Now, remember, that's the platform and the promise. They still have to run the gamut of the House and the Senate. And what I've found historically is when you have a all Democratic government or all Republican government, things tend to get more out of whack from a policy standpoint versus when you do have balance, whether it's a Republican president and a democratically controlled, House and Senate, or vice versa. When you have that check and balance in there, you tend to get cooperation and you tend to get policies that tend not to be far left and far right. So when I've looked at historical situations, the one I'll bring in is I remember more vividly because I was more of an adult at the time when President Clinton first got in office as a Democrat. He was trying to bring in universal health care, and he had a very rough first 4 years. And most would say his first 4 years in office were not very successful as a president. However, I think he learned very well, despite some things that happened to him in office, that in the second term, he moved from more of a far left to a middle position and worked much better with the Republican side along with his Democratic partners. And he had a much more successful second term. But again, the market tends to look at, again, what is the final impact happening to the corporations and the economy in the country. Another slide that illustrates this, and if Cynthia can move to the next one, please, is again, this is going back to 1928. It's the S&P index returns in U.S. years for the presidential election year. So this is looking at the election year itself. And again, there's many factors that impact the stock market and its return. But again, the common concern of investors is how the stock market will be impacted by the change in Americans' presidency. And there have been 24 elections since the S&P index began. And in those election year, and again, just the election year, not the whole cycle, 20 of the 24 years, 83% provided positive performance. When the Republican was elected, again, for that year, again, not the total 4 years, the average return was 15%. And when the Democratic president was elected, the average return for that year, first year in office, was 8.5%. So again, though, the average S&P return for all election years going back since 1928, when you looked at the election year itself, the average has been about 11.58%, which is slightly higher than just the average return for all years, which is 11.54%. So again, as I started our presentation, it's exciting to kind of get in there. People look at change. with leadership as, okay, things are going to be better. It's kind of like when we have our New Year's resolution every year, right? I'm always going to make this better. I'm going to lose weight or get in better shape. When they look at a new presidency coming in, they're always looking at hope of, hey, things are going to change for the positive. But what we have found out, again, it tends to be a little irrelevant who the president's is in regards to the market and how the market perceives that going into the election year and then coming out of the election year as things become known. Another slide I want to take you through, because we're focusing in just the US. And one of the things I like to remind people is that the world doesn't revolve around the US. It's becoming less dependent on the US. If you actually look at GDP of the world, and the impact the United States has is actually decreasing because we become more of a globalized economy. But we tend to look at crisis and events. And if you look at the graph here, I got one ahead of myself. Sorry about that. I'm looking at the slide here, U.S. stock market and returns after major geopolitical shocks. And I'll get to the geopolitical landscape of crises in the second slide. It's very normal when there's something negative that happens in the world, and the most recent has been, the invasion of Ukraine, and we really don't have those final numbers of where we bottomed out as a market and days of recovery, because that, unfortunately, that war still is going on. But if you look at some of the other more recent, we had the Boston Marathon quoted here, the U.S. terrorist attacks, Iraq's invasion of Kuwait, the Tet Offensive, all the way going back to Pearl Harbor. You can see the impact of that event. And what I mean by that is days until the market kind of bottomed out. And then the last column you'll look at is days until recovery. And again, the worst of it obviously was Pearl Harbor. It took a little less than half a year for the market to bottom out, and a little more, almost a year for the market to fully recover. Again, when something bad happens, it's the fear factor, flight or fight. Market has to deal with uncertainties. There's a lot of uncertainty going on from a government standpoint, what industries are being impacted. And I think what that reflects is something that's, if we sit back and take away the emotion of the event, and again, those events are real people are being impacted in a terrible way. But when you look at the economics of it, once the market is able to process and stabilize the information, the market tends to return back to a norm, assuming that there is not a negative impact to how the market processes. And a good example is what we just recently went through with COVID, right? That was obviously a worldwide risk that impacted the market. And the reason for that is there was an underlying supply issue that impacted companies and industries all across the world, because we're dependent on supplies. And if the supply chain is disrupted, that's obviously going to have a chain reaction all the way down to the consumer. Top that with an actual labor market challenge, and we're on a whole new labor market paradigm right now. Those kind of things we felt very quickly in the market because of that impact. And we're now just kind of coming out of that. And the reason why it's taken a little longer is what happened in 2022 with the federal government trying to counterbalance the perceived impact of COVID, because at the time when COVID happened, no one knew how deep COVID was going to go and how badly it was going to impact our society. And lucky that it was much more short-lived, but the overreaction, and again, hindsight's 2020, but the overreaction to what the federal government did put the market into a tailspin in 2022, which, thankfully for 2023, we've turned that around. And again, Cynthia and Chelsea are going to talk about that. But geopolitical shocks are always something that's going to happen. We're still waiting, obviously, what's happening with Palestine and Israel, unfortunately. But if you look at history I challenge always people to think back, and maybe it's easy to look at things in decades, but if you look at every decade, there are things that we would say are not, very positive. I mean, I always go back to the 60s because that's when I was born. And I'm thinking just in our US soil, we had two assassinations, actually three assassinations of of a president, senator, Martin Luther King, all that happened. We had all the change in our society going, the whole change in our culture, the openness of our culture changed. We had the Vietnam War. All these things happened in the 60s. I will tell you, if you go through the 70s, 80s, 90s, every decade has its challenges, but yet the market, seems to persevere through all of this. And if we go to the next slide, and this will be the last slide I'll comment, is crisis and events. I always want to remind people that we live in a fluid and dynamic world, and it'd be nice that everything works the way we want, but that's not reality. There's things that happen in our own country. There are things that happen around the world that are considered crises and events that can impact us. And so what this chart really shows here are some major events that happened since 1970 through 2023. And again, I'm not trying to minimize these events at all, and we're disregarding the fact that we're just looking at quote money in the market and its impact on our portfolio. But the market tends to process information, again, going back to what does it mean to the companies that are in the market, that make up the S&P 500, that make up the Russell 3000. What does that mean? What does it mean to debt servicing of these organizations? And what you'll find that since 1970 through 2023, the average S&P return has been 10.5%. So it's slightly below. It's about 1% below the total, the average return since 1928. And if you go through this graph, you'll see if you average it, it's really a straight line going, left to right. And when you look at the valleys, you can pick, some of the worst events. You go back to 2008 and 9, and you can see, Lehman Brothers files for bankruptcy, and that was the big Great Recession, right? You can look at 2020, and you'll see a little crevice there, and that's the first confirmed COVID case in the United States. These events happen. There's complete uncertainty. The market reacts negatively, and then as things tend to work out, the market recovers. So patience in your strategy, which I always, I think is key. We always talk to our clients about setting your goal, setting the strategy to reach that goal, picking the underlying investments that will work the strategy, and then refining and reviewing that is the key to your longer term success. Again, that's a long term, and when I define long term, I'm talking about 7 to 10 years or longer. If you're going to buy something in 5 years and you want to invest in the market, the approach is similar, but we have to look at how we de-risk the portfolio, given the fact that 5 years usually doesn't give you sometimes the time to work through a down cycle in a market. But I think this graph puts things in perspective that the economy has gone through a lot of major events since 1970, and yet the market has put investors, if you've committed to the market is committed back to you a return of 10.5% using the S&P 500 index just as a barometer. So hopefully, what I talked about today regarding the election, while that's fun and it is exciting because it means change, sometimes people don't look at it as positive change, and some people look at it as positive change, depending on your personality and what you're hoping to see. But at the end of the day, we don't believe, while the presidency is an important figure and they are trying to set policy based on their platform, that as long as the markets perceive an understanding of what that's going to be, and it's not going to be a detrimental impact to how the economy will operate, the market tends to take that with, okay, the election's done, let's get back to business. And that's kind of our view on that. At the end, we'll open up to questions, but I'm going to turn it over to our next presenter, who will talk about the labor markets.
Thanks, Frank. Good morning, everyone. The overall theme for these next few slides is data regarding the economy, and this first one is a dashboard of the labor market. We're gonna take a look first at non-farm payroll gains. The overall theme for this is that the labor market has held up relatively well throughout this economic cycle, but its strength is gradually easing. Not necessarily indicative of a recession or an impending recession, but there is a deceleration happening. So as we look at the pace of job gains, while still robust, it's trending lower and lower since last year. As you see through this dark gray line here, through the end of August, the 3-month average reached its lowest level since the start of the pandemic at 150,000. I would note that in September, the jobs data that came out added 336,000 gains, and so that's a little bit more of a bump, kind of like what we saw in May 2023. Overall, the average is still trending lower. That might have lifted it somewhat, and we think it might be a big contributor to that would be a key demographic shift, and that's in this graph on the right now, the labor force participation rate. And I found this graph particularly interesting because it speaks to a long-term demographic trend, and it also helps answer the question that a lot of people have asked, which is, if the unemployment rate is so low, how come I'm seeing help wanted signs everywhere still? Why does it feel like if there's not a huge need for people to be employed, but there's help wanted, there seems to be some type of gap. And I think a key answer to this is this demographic shift. So when we're looking at the labor force participation, this light blue line are people under the age of 55, and the dark blue is over 55. And you can see their participation percentage has remained relatively in lockstep leading up to the pandemic and then even through the pandemic. What's helped prop this labor market up is that the under 55s have returned their participation rate to those pre-pandemic levels. However, the over 55s may have taken the pandemic as an opportunity for early retirement. And at any rate, the baby boomer, the aging population, there's a significant portion of them who have permanently left the workforce. So we'll take a look at what this means looking ahead. But the overall theme here, if we go to this last graph here, this key market indicators, this is a heat map. You want to think of red and the gradient of red representing the decline, green and the gradient of green representing an incline. The overall trend here is we're seeing some normalization. So some deceleration in the market for the labor market. It's certainly cooling, but not necessarily indicative of a recession. Next, taking a look at unemployment and wages. So keep in mind what the Fed wants to do is tamp down inflation. One of the contributors to inflation is wage growth, and one of the indicators of a cooling economy is the unemployment rate. So these are two factors that the Fed is looking at with some scrutiny. So the first is taking a look at wage growth. That's this light blue line here. Wage growth is decelerating, and this should give the Federal Reserve confidence that inflation is sustainably coming down. Those cooling labor market conditions, like we just saw in the previous slide, they've really contributed to a moderation in wages, which are now down from their peak at 5.9% in March 2022. They're still above the long-term average. You see this light blue dotted line here at 4%. That's the long-term wage growth percentage average. We're still above that. However, there's not significant upward pressure on inflation, which from the Fed's point of view is a good sign. Instead, it looks or it appears that workers are being compensated more so for their prior losses in purchasing power in 2021 and 2022 after their wages failed to keep pace with inflation. Moving into the unemployment, looking at this key metric, as we said before, we're really at a record low. The 50-year average has trended around 6%, and we're hovering around 3.8%. So we're certainly at a low, and we don't believe that we're going to see a material rise or a material change in that unemployment rate going forward. And again, this goes back to that changing demographic we saw, a large number of people who in the 55 plus who've permanently left the workforce. But the other is, as the economy slows and demand begins to cool, businesses are likely going to reel back, maybe not move into layoffs, but probably reel back their hiring efforts to deal with that slowing demand and higher costs. Go to the next slide. All right, inflation and Fed tightening. This is what the Fed has been working for and what they like to see. We have two graphs here. I'm going to look first to the left-hand side, contributors to headline inflation. And this is broken out. These different colors represent these different factors that influence it. You can see we are down from our peak at 9.1%. See that peak there? And when was that? June 2022. We're now down to 3.7% through August. As of October, inflation was at 3.2%. So we are trending in the right direction. A key component of this is two factors that contributed pretty greatly to the high inflation: energy prices and prices of new and used vehicles. So those have since reversed trend. And despite a slight spike in energy prices in August, things seem to be pretty much moderating as far as those prices go. This blue graph here, or these blue bars, I would say, these sort of medium to dark blue, this represents shelter. This has been stubbornly and persistingly high. I want you to think, though, of back in May, I think it was our last market noise seminar. Frank mentioned that as far as shelter prices go, that in and of itself is a pretty long-term commitment, right? You've got a lease for 1 or 2 years, a mortgage that you're committing to for 5, 10, 50, 30 years. And so we're likely to see those remain pretty persistently high, at least for a while. There is some signs, though, that that's starting to come down and that we're getting some relief. Now, the graph on the right-hand side, which makes me crazy because it's a different graph, but uses the exact same colors to represent different variables than the one just next to it. But this is contributors to core services, excluding shelter. This graph is a favorite of Chairman Powell's. This is what he's looking at the most when he's tracking inflation. And the key contributor here, you can see represented by these red lines. These are transportation services, excluding airfare. Airfare prices, believe it or not, have been coming down since May of 2023. But this overall red bar that's continuing to persist with inflation is really representative of a lagging effect of those new and used vehicle prices being so high. Because one of the biggest components to transportation services is auto maintenance and auto repair. So if you think about it, all of the people in 2021 or 2022 who thought, I could use a new car, but I'm going to wait till these prices cool off a little bit. I could probably wait this out a little bit. A lot of them have been investing and spending a lot more in maintaining the car they have until those prices moderate. And that's why we've seen this representing such a large chunk of this inflation. Again, with that being a lagging indicator, we believe that as these new and used vehicle prices continue to come down, that this number should, or this portion, this variable, should begin to come down as well. Overall, the theme is that inflation, while it's still above the Fed's 2% target, it's gradually falling to a more manageable level, where we expect to see near 3% inflation by the end of 2023. And then the hope would be by the end of 2024, inflation returning closer to that 2% target. Again, what the Fed is aiming for. All right. This next piece, the Fed and the interest rate. So the Fed has hiked rates a cumulative 5.25% over the last 18 months. Through September and the November meetings, the Fed left the federal funds rate unchanged with its target range of 5.25% to 5.5%. And so while these moves were really popularized, forward guidance is still a little bit hawkish. The Fed expects a pretty resilient U.S. economy. And in fact, in the September summary of economic projections, real GDP growth expectations, those more than doubled over the course of 2023, and they remain pretty high for 2024. So what the Fed is essentially trying to do is, and I know we've heard this phrase so many times, but they're trying to navigate the soft landing where they cool down the economy to bring inflation to a more manageable level, but they don't want to cool it down to such an extent that it leads to a recession. The data we reviewed in these previous pages show that so far, they're pretty successful in cooling down inflation, and that the data isn't yet showing the risk of a recession. In either event, what we're seeing, whether it's the Fed somehow over-tightening and leading to a steep recession, or maybe just a more mild slowdown, we anticipate that at some point next year there may be some rate cuts, whether it's sooner because of an intense recession or later because of a more soft landing scenario. In either case, with both of these outcomes, this should bode well for high quality fixed income investments. Cynthia is going to discuss what those portfolio implications would be and what that would mean as far as your investment plan.
Thank you, Chelsea. Good morning, everyone. On the next slides, we're going to look at the valuation monitors of the 10 major asset class. The way that we are looking at is a Z-score, which is used to measure how a value is differ from its median average. With a Z-score 1, it shows a 68% probability that the value will be aligned within the dark gray shaded area. And with a Z-score of 2, it shows a 95% chance that a value will align within the Z-score of 2, between this Z-score of 2 and -2, which is the dark shaded gray area and the light shaded gray. And with a Z-score of 3, which indicate a value lies within the 99% chance that a value will line it within the Z-score of -3 and +3, which is covering the majority of the areas that we've seen on this chart. So in the on the flip side, if we have a Z-score above 1, it shows that a asset class valuation is that 32% of a chance that the valuation is kind of stretched or overvalued comparing to its long-term average. So on this chart, the green dots are the valuations or the Z-scores at the end of 2021. We take the municipal, which is the second bar on the left, as an example to show that where the valuation are today and the valuation of the municipal bond back in end of 2021. Now, municipals were way overvalued or valuation stretched at the end of 2021, comparing to now, they are undervalued, meaning that the valuations of munis are very attractive comparing to their long-term average. On the equity side, you would say that the large cap blend and the large cap growth are the two asset class that the values are slightly stretched comparing to the long-term mean, but nowhere close to their valuation by the end of at the end of 2021. So what does this tell us? When you look at the valuations, it's one of the fundamentals we're going to look at to position our portfolio. Overall, this tells us that the major bond asset class, the fixed income, treasuries, munis, core bond are all very attractive values right now. And given the yield are now around 5%, we really expect that 2024, that's going to be a bull market for the fixed income. And with the expectation that Fed is pretty much going to done with their interest rate hikes, and it's likely, depends whether we will have a moderate recession, which Fed going to start to cut rate earlier in the first half of the 2024, or if we skip a recession and landed on the soft landing where Fed may decide to cut rate at the second half of 2024, this is going to be a great tailwind for the bond market in general. On the equities, international stocks and emerging market, U.S. small and U.S. value are all very well valued right now. Valuation are much more attractive comparing to the large cap blend and the large cap growth. But I want to remind everyone, and we are a little bit cautious about adding more exposures to the international and the emerging market right now. When you look at where we are in terms of battle the inflation, U.S. Fed is pretty much get their job done. There might be one more rate hikes, and we should be done with any interest rate hikes. But when you look at the European, most of those central banks in the Europeans are still dealing with very stubborn inflation. So there's a longer journey and a harder battle for them to work through and work to get the inflation down to the right path. So given that expectation, central banks in the Europeans may still continue to raise rate. And we're in the US, we're expecting a rate cut in 2024. So we would be a little bit mindful of adding more exposures to the developing market, into the developed market outside the US until we have more clarity about how the central banks are going to battle with inflations in those European countries. Next slide is a discussion about the valuation dispersion. Now, this year we enjoyed a really good rally that S&P generated 18% return. NASDAQ, which is an index for the large cap growth, generated 35% return, which is really good. But at the same time, valuation dispersion is way wider than the long-term average. When you look at the valuation of the S&P 500, it is now trading above 18% forward earnings, where the 25-year average is 16%. For active managers, those are the managers who would be more actively selecting the stocks than the index fund, where you are primarily just investing in a basket of stocks which are included into the S&P 500. When you look at the valuation spread, the current spread is 14.3, where the 25-year average is 11.7, which is telling us that there are stocks that are very expensively valued in the S&P 500. And there are stocks that are still very attractive in the S&P 500. So with those dispersion in the valuation, if you are investing in the index, you are gonna essentially investing in more of those stocks that are expensively valued. Active managers will help you to be more selective and to help you look at more of the fundamentals of those financial health of those stocks to decide which stock is the best for your long-term performance going forward than investing in the basket of the index stocks. This chart shows a different angle to look at how the valuation are stretched for the Magnificent Seven, which are the stocks of the Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. Those 7 stocks in 2023 has generated up to 50% returns, which contribute to 15% out of the 18% return for S&P 500. So when we look at the S&P 500 year-to-date return of 18%, 15% of those returns are coming from these 7 stocks, with the rest of the 493 stocks only contribute 3% of the overall returns to the S&P 500. So even in the first slides, when we look at the valuation, large cap growth is currently the most expensive asset class. There are still opportunities in the large cap growth, and if we could be more selective and using an active approach to identify those opportunities, there are still good returns that we can help add in the large cap growth exposure in your portfolio. Well, next slides, we're kind of looking at how the strong market performance have leading to the next 12 months, what the returns going to be look like when the consumer confidence are at the peak, and the 12 months following the consumer confidence are at the trough. When the investors are concerned the market, there are uncertainties like Frank were discussed about the election that's going to add uncertainty for 2024. There are these geopolitical issues that people are concerned that where this world going to lead us and what that means for the investment. Those concerns can add to the consumer sentiment. But when we look at those cycles in the last 50 years, following the consumer confidence trust, the average returns for the following 12 months is 24%, where if you feeling very comfortable that everything looks very rosy, the market is very steady, economy is growing, employment is very steady and strong, that's usually where the consumer confidence are at the peak. And if you invest at the peak, the following 12 months returns of the market is around 3.5%. So that we're not suggesting that in 2024, we're going to have another 24% of market rally, but there are still some concerns that bring investor to doubt about, okay, is this still a good timing for me to stay in the market? Or if I have cash sitting on the sidelines, should I put it into the market? If you look at where we were, the trust for the most recent consumer confidence was in June 2022, where it was only 17.6%, and we are now close to 70. But the long-term average of the consumer confidence is 90. So we're not close to the long-term average yet, suggesting that there might be more potential returns that if you stay in the course than jumping the boat if you have concerns about the short-term volatility in the market. And the last slides we're gonna look at is really, do we have crystal balls? No one really have the crystal balls, but when the investor decide how we gonna position the portfolio, whether we should overweight, underweighting, swing to cash, sometimes people do act like they have crystal balls. But when you look at the investors who stay in their long-term target investment strategy, and the investors who get swayed by the short-term volatility and adjusting their investment allocation very often, you will see that for those who stay invested in the long-term strategy, those are the investors being rewarded for their patience. For the S&P 500 on the left chart, it shows you that in the last 30 years, if you stay fully invested, you get an average return of 9.6%. And if you only miss the 10 days, that is not missing the 10 days of every calendar year for the last 30 years. It's just missing the 10 best days for the last 30 years. You're going to lose 3% of the returns. And if you miss the 20 best days for the last 30 years, your annualized return will be halved. So unless there is a reason that your financial situation changes, you may want to revisit how your long-term investment strategy should be. Then staying in the course and stick with your long-term strategy will give you the best rewards. The chart on the right give you another angle to look at. Okay, well, there's the best 10 days and there's the worst. How should I position my portfolio to stay in the course with the best days and avoid the worst days? The reality is most of the best days are clustered around the worst days. Take 2022, when COVID hit us as an example. The COVID sell-off was a 34% market drop in just a month. In 30 days, market drops 34%. The best days for COVID recovery is there are 3 days of the market recovery right after the sell-off. That's March 24th, 9.4% returns, March 13, 9.3%, April 6, 7.1%. Now, if you stay in the course, you would recover 22, almost 23% of the loss in just 2 weeks. If you jump the boat and wait until June, July, which is where we start to see we kind of skip the impact of the COVID and everything are back on track, it will take you a much longer time to recoup that 33% loss because you missed a rebound of 22%. So with that, we really suggest you that when it comes to the portfolio management, try to avoid any fair trade and really focus on the fundamentals and focus on your long-term investment allocation strategies. Well, the key takeaways for today's presentation, we've discussed about the employment market, that we started to see a little bit softening in the employment market, but overall, it is still very resilient. And we do expect that we will land in the soft landing zone than a recession in 2024. Fed is pretty much done with their interest rate hikes. There might be one more, but with inflation continue to coming down from its peak and is on the right path to the 2% Fed target inflation, we are expecting that in 2024, there might be one rate cut likely in the second half of the year. When it comes to election, what market doesn't like is the uncertainty. Market doesn't really care about politics or who's gonna win, who's gonna lose. Once that all settles, we have more clarity. The market will be more focused on the fundamentals. valuation spread have give active manager a really good opportunity to add value this year and next year. Where in the 2021 and 2022, that investing into the index munis index fund give us a really good rally. Going forward, we do see that active managers gonna help us to provide better returns. And when it comes to your investment portfolios management, it's always making sure that instead of letting the fears to make a decision of shifting your long-term strategy, focus on the economics fundamentals and your long-term goals.
Yeah, thank you, Cynthia. Yeah, just a couple things I did want to add. Again, to provide some broader perspective. The last couple of years have been rough because you had COVID. I call it the the COVID effect, where we had this hangover from if you look at prior to COVID, we had these ultra low interest rates, and anytime you have anything in excess in the marketplace, it tends to come back and bite you in the backside. And while everyone was loving 2% loans, 3% loans, it actually from an economic standpoint rendered the bond portfolio portion of your investing pretty much negated it. So it put all this pressure on the stock market to drive any type of total return, unless you were an investor that just believed in the stock market. And so what ended up having is it required the Fed to overcorrect in the shortest amount of time effort to jack up the interest rates. That created the downfall of 2022, where you had bonds and stocks going down significantly. And the last time that happened, it was about 40 years ago. So you need to kind of look at this cause and effect, because some of the things that happen, and Chelsea talked about, there's this latent effect. Some of these policies that the government puts in, we don't see the final impact maybe a year or two out. What the Fed does is not surgery. It's not like precision with a scalpel. I always tend to look at the government as a blunt force trauma approach, where they come in with a hammer and say, all right, this is what we're going to do, but then we don't see the final effect afterwards. So, we're in a much better position than we were in a year ago. I can tell you last December, everyone was down, everyone was frustrated, everyone felt we were going to have a recession this year. And depending on who you talk to, everyone still felt it was a high probability. And we're looking at it, it's still out there, but it's probably about a 25% probability. I mean, there are cracks showing, and this is the latent effect, and why we hope the government doesn't try to overcorrect and come in as the soft landing that Chelsea talked about, because default rates are up, right? Part-time hiring is up, and one reason why I bring up part-time hiring happens when companies start to become unsure of the economy. Instead of hiring full-time people, they will job out work, start doing some part-time work. Obviously, interest rate costs for everyone has gone up significantly. So those are things that kind of hang around, and we're hoping the government sees this and kind of allows for a calming effect, which is what we're hoping is December they'll see that inflation has come down significantly, as like we talked about, and all these other factors that show that the economy is slowed, and they won't go for this other quarter percent raise. Now, will that be the tipping point? We don't think so, but it's just going to add more and more pressure. We do think that by the end of next year, third, fourth quarter, that the government will be most likely looking to lower interest rates, but at a much slower speed than they raised it, and go back to what we call a historical norm between 3% and 5% Fed fund rate. And again, that'll allow the bond portfolio to still be relevant. It gives the Fed powder again, that if the economy ever weakens, they can lower interest rates to juice up the economy. So they're really trying to lay the groundwork for the next bull run. And usually bull runs tend to run anywhere between a 5 and 10 year cycle. Obviously, our last one before COVID was the longest. It was about 11 years. So those are things that we think are happening on the positive side. But we do expect next year to be a little volatile again, just because it's an election year. And we're still trying to navigate the soft landing. Well, not we, the Fed is trying to navigate it. We're trying to guide our clients to be comfortable with how the airplane is going to land on the runway. Hopefully it'll be soft, but most likely you'll have some bounces along the way as we get into the year. With that, we do want to open up questions. I know, Chelsea, there's a question for you here. They want you to expand upon why the energy prices dropped so significantly on the CPI graph. Was it supply and demand? Was it government intervention or other factors that contributed to the energy costs shrinking in relationship to the prior graph?
Yeah, that's an excellent question. Overall, this would be a factor of supply and demand. Part of it is on the international side. OPEC is still, they were actually supposed to have a meeting recently, I think just a couple days ago, but they postponed it with some of their African counterparts regarding oil production, and they're still trying to work some things out there. What they're hoping to forecast is a cut in some of their supply, which would help raise those prices back up. But the biggest contributor, and one that probably isn't advertised so much for maybe political reasons, is that the U.S. oil production has ramped back up. Biden very famously campaigned on slowing down U.S. oil production, and it essentially ground to a halt when he first got into office. But we have recently, actually, I think a week ago, surpassed our record level of oil production, 13.2 million barrels in a day. The previous record was 13.1 in 2020, February 2020. So we are now back up to our record levels of oil production. The cynic in me says that this may be a little bit politically motivated. You know, if gas prices are low and the economy appears to be doing pretty well, an incumbent president is more likely to get some favorable election results. But this could also be, again, that concern that OPEC, they want to cut their supply to help raise those prices again. Other factors like geopolitical risks, the ongoing war in Ukraine, the recent release of hostages by Hamas, a lot of those moderating factors can certainly impact oil prices, but supply would be one of the biggest reasons. And then the overall global economy gradually slowing, particularly in Europe, starting to contract, that decreases some of the demand. So there's been kind of this push-pull as the supply is increased and demand is moderated, that's helped bring those prices down.
Thank you, Chelsea. Any other questions? And again, if anything, you forgot to ask something today and you're ready to go back to bed tonight or wake up tomorrow and you want to ask something, please feel free to email us. We're here to be of help. If there are no other questions, we want to thank everyone for their participation. Giving us an hour of their day is really, gracious on your part to listen to myself, Cynthia, and Chelsea. Our goal is to really help guide people through these decisions, make the decision process easier, and understand that your investment portfolio is one part of the overall picture of managing wealth. It's the sexy part because it gets all the press all the time, but there's always a lot of other decisions that go into managing your wealth successfully and to drive the type of return on life that you're looking and seeking. So with that, we want to, on behalf of the team, we want to wish you and your families a very blessed holiday season, health and happiness, and going into the new year. And thank you for your time. And again, we're here for you if you have any questions. Have a great day, and thank you.